Now that we know how to compute returns, let's turn to risk. Let's first start with the definition of risk in this context. What is it? What is financial risk? It's the possibility of suffering a loss. And we're going to measure risk. We're going to start with volatility. So this is going to get a little weird because we're going to spend some time talking about volatility, but then eventually we're going to say, oh, by the way, there's actually a better way of measuring risk that's different, and we're going to call that thing beta. But before we get to beta, first we need to talk about volatility. So volatility is the variation of prices over time. So think like looking at a stock chart, you're going to see prices go up and down, up and down. Like stocks are risky. There's a lot of uncertainty about valuation. As news come in, price will go up, price will go down. And as a result, we're going to see volatility, right? And that volatility, at the points where the price dips, there's this unexpected drop in the price. That's financial risk, because if that's at that point you need to sell or you decide to sell, you may be facing a loss in your investments, and that's what we call financial risk. Or even worse, there can be a crash, major drop in the stock price, and not just in that stock, but in all across the market. And at that point, maybe you need to sell and get out because you can't really tolerate any more losses. And then you lock in your losses, and that's a big financial risk, right? So we're gonna measure this at first using this volatility of prices going up and down, and we're gonna use standard deviation, the statistical concept called standard deviation, to measure a standard deviation of returns as the measure of volatility and measure of risk. And we're gonna call this thing sigma. The Greek lowercase letter sigma is going to be our measure of volatility. And this is the formula. What we have is the square root. If you don't take the square root, we find variance, right? You probably know this concept from statistics classes. Variance, you take the square root, you find standard deviation. So what is variance? Variance is we have this individual returns. So those are RIs. Individual returns minus R bar. R bar is the average. This is the arithmetic average we computed before. So those are deviations of each return from the mean squared. So those are squared deviations from the mean summed up and divided by t. T is the number of returns in the series you're looking at, t minus 1. This is what we call the sample standard deviation. Okay, so then if you open up that summation, that's what we have. The second part of the formula is we have each period's return. This can be day, week, month, quarter, year, whatever it is, but each period's return minus the average squared times next period's minus the average squared, so on and so forth, divided by t minus 1 square root. So that's how we compute volatility. Now let's do an example. Let's go back to the monthly returns of Microsoft, so actual numbers, and let's compute the volatility of those returns, of Microsoft's returns. So let's compute the standard deviation of Microsoft's monthly returns. While doing that, we need the R bar, the arithmetic average, and we had already done that. We had found that to be 2.32%. So now if you look at this series of numbers, you can eyeball it and figure out that this is a pretty volatile series. If the returns were very close around the mean of 2.32, a little bit higher, a little bit lower, like 2.1, 2.5, 2.2, 2.4, then there wouldn't be much volatility, right? And this wouldn't be a risky stock, risky investment. But here, the returns are all over the place. And that's what we are trying to quantify, right? We're going to probably find a large amount of volatility here. And then this will capture the idea that there is a good chance of having, high return months, but also some pretty bad months. For example, like September and October. So that they come hand in hand, they come together, right? You can have months like June and July, so June and August, but with that amount of uncertainty in a stock, also there's going to be greater chance of having months like September and October. And that volatility number, that standard deviation number, this is what it's capturing. Okay, so let's plug the numbers in. We have our R bar, arithmetic average return, 2.32, just the mean of these 5 numbers. And then we plug them in our formula. If we are just using directly the formula, square root of these deviations from the mean. And here we could do everything in decimals, or you can just plug it in the percent numbers, like 11.1 minus the mean of 2.32 squared times, then we do it for the second return, 0.74 minus 2.32. That's going to be a negative number. Here the deviation is below the mean, so deviation is a negative. But then when we square it, we're going to get a positive number. So all of these will be positive numbers, right? And that's on purpose because we don't want positive deviations and negative deviations to cancel each other out. We want positive and negative to add up. That's the idea behind standard deviation, right? Then the third month above the mean, then fourth month below the mean, and the fifth month below the mean. And then we score them, take the product of all these, divide by t minus 1. Here 5 returns, 5 minus 1, 4. And then take the square root, gives us our sigma, standard deviation of 8.08%. So we have a mean of 2.32 and standard deviation of 8.08. So now, is this a lot? So we're going to be able to put this in context on the next video when we talk about the Sharpe ratio. Then we're going to compare the mean against the volatility standard deviation, and then we're going to have a better idea about that risk return trade-off. So that's going to come. But before then, before we get to that, I want to show you one additional way of doing the standard deviation instead of just plugging in the numbers directly in the formula. Just an implementation, step-by-step implementation that may be more appealing to some of you when you have to do it without the help of Excel, for example. So let me show you. Here you can just create a table of returns. So the 5-month returns that we have in that column, and at the bottom you can compute the average, 2.32. So then you create a new column next to those numbers. That's deviation from mean. So R minus R bar. So we subtract each return from the average at the bottom. So for example, 11.10 minus 2.32 is 8.78. So the June return was 8.78 percentage points above the mean. July was 1.58 below mean, so on and so forth. So these are deviation from mean. Next in the formula is we take the square of those deviations. So squared deviation from the mean. So 8.78 squared, for example, is 77.0884. Negative 1.58 squared is 2.4964. So on, you do it for all 5. And then add them up, sum of squared deviations from the mean, 261.4356. Then in the formula, after that sum, right, we divide things by t minus 1. We divide the sum by t minus 1. T minus 1 is 5 minus 1, 4. So we divide this by 4, and then we take the square root. That gives us 8.08, which is, because we put everything in percent, we got the answer out in percent. 8.08% is the volatility.